that, or do they really need to show up and deliver?
Yeah, I think, again, there are a lot of headwinds that they are facing, and so the estimates have come down. But the real kicker to me is what are they going to show around generative AI? I mean, really, China's story is known. It's embedded in the numbers at this point of time. But if they can come up with, a large language model that's going to feature in their next version of the chip, which they are going to launch another iPhone in September, that's going to drive huge demand, a refresh cycle that everyone is anticipating, and there is pent-up demand. It's a question of what kind of features can they integrate. And Qualcomm, actually, they said yesterday their premium chips are doing quite well, and there is demand for AI features that they have incorporated. So in the end, it comes down to the features and what they can do around generative AI.
Is Apple behind in this, though, Mandeep? Because we know a large part of their team was dedicated to looking at autonomous driving. They had to do a shift in strategy. So where do they stand?
Well, so clearly, when you compare the capex of all the large hyperscalers, I mean, Apple isn't spending any money on NVIDIA GPUs, at least based on their capex numbers. So clearly, they've been behind in terms of investing in developing their own large language model. But from what we've been gathering off late, they are trying to develop a small model as opposed to, the billions of 500 billion parameter models that we keep hearing from GPT and Gemini. And so that's more appropriate for the phone. The question is, can they integrate it in time for a September launch? And I think that's where the CapEx numbers is going to give us some sense, but clearly they are behind.
The CapEx numbers have been fascinating this season, Mandeep. Google, $12 billion. Meta said something between $35 and $40 billion for their forecast. Both Microsoft and Alphabet said they expected to materially increase from where we are. We've seen investors reward that in some cases and punish it in other cases. How thin are investors' patience when it comes to CapEx and actually seeing it turn around into something that is monetized?
Yeah, look, Microsoft clearly is out there in terms of monetizing that generative AI capex quite well, and it's reflected in their, Azure numbers, the growth that they showed, $4 billion run rate around Gen AI workloads. Add Copilot. So clearly there is a path to monetization. Meta, on the other hand, has incorporated a lot of the AI features within their apps, and that's actually working quite well for them. The question really is for everyone else, how does that capex translate into real monetizable revenue? And the answer isn't very clear because these companies already have a lot of enterprise data and they're able to roll AI services on top of that. That's what makes it sticky. But for anyone else developing their own model or developing something outside, it's very hard to make sure you get all the data and you're able to monetize it right away.
And it's an expensive endeavor because not even are the parts expensive, there are supply shortages. I mean, the chips industry swings between surplus and deficit so quickly. The labor, the talent, it is expensive. So Mandeep, even though we have companies plowing tens of billions into the project of AI, how volatile is it? How volatile is the cycle of chips and incorporating it into their businesses?
I mean, based on what we are reading with the capex numbers this quarter, this is not a short-term phenomenon. I think what you are going to see is a steady ramp up. I mean, clearly you're not going to see 40-50% capex increases, once you kind of lap these comps. But what they're trying to do is to build capacity. And these models are getting larger and larger in size. I mean, right now, all the focus is on data centers. That's where all the infrastructure lies. Now it's slowly trickling to devices. And look, there is demand, and that's what bodes well for NVIDIA, because even though they have tougher comps, if capex numbers are going up 40-50%, a lot of that is going to trickle down to NVIDIA and some other players, but clearly NVIDIA has the chips that everyone wants, and they're still supply constrained.
Okay, Mandeep, we'll see what the numbers tell us today. Mandeep Singh of Bloomberg Intelligence. Coming up, more earnings for you. Tanger reports a strong start to the year as it raises its full-year guidance. We're going to be sitting down with the CEO, Stephen Yalof, on the company's strategic vision. That all to come next. This is Bloomberg. Tanger has reported a strong start to the year. They had significant growth, a positive outlook, and now they're focusing on diversifying the uses in its outlets. I am pleased to say that joining me now is the CEO of Tanger. It is Stephen Yalof. Stephen, thanks for stopping by. Great to see you.
Thanks for having me.
So in a lot of the earnings that we've gotten, even over the past week, there are signs of concerns about the consumer. We've seen it in food and beverage, McDonald's, Starbucks, even Amazon talked about this. With the consumers, the customers that are coming into your outlets, are you seeing any signs of weakness?
Not in the first quarter. In fact, January, obviously, sales and traffic inhibited a little bit by weather. February came back quite strong and March even stronger. And, I think some of that had to do with the Easter selling season, but spring breaks in both March and April, when people are on the road, moving around, going to some of these resort destinations where we have a lot of our shopping centers, we seem to get a lot of traffic. And we're seeing cars not only during the week, but also extending into the weekends as well.
I was going to say, because I told you this in the break, I remember growing up and passing your outlets on my way to the beach and saying, I think we need to stop here. But how do you change from we're just driving along the way, we happen to see, we go into a destination itself?
Well, what's happening now is a lot of those markets where we have our shopping centers are becoming permanent or growth markets for permanent population. So we're seeing some of the folks that are moving out of cities, moving into some of these, what we would have called secondary locations back in the day, and now markets that are growing at great leaps and bounds. Places like just outside Savannah in Pooler, Georgia is a great example, where we have a shopping center, one of the great growth stories from a local economy point of view. And so we're seeing that tourist customer, that drive-by customer that we've seen for years and years, still coming to our centers, but now we're catering a little bit more towards that local customer who comes more frequently, comes during the week, wants a better food and beverage experience, wants better amenities, et cetera. So these are the things that we're positioning ourselves
the kind of stores you have, the tenants you have, they do run the gambit. You have the lower end, you have things like Navy, Old Gap, and then you have the aspirational luxury, Kate Spade, Michael Kors. With the types of people that shop there, have you seen a bifurcation in their behavior?
Well, we actually have expanded our catchment. So as we add more aspirational brands, which is what you're referring to with the Kate Spades and the Michael Kors and the Coaches and the Ralph Laurens, there's an aspirational customer that's trading up. So you have folks that probably won't shop those brands in other in other venues, streets, malls, full price venues, that might their point of entry might be through the outlet because it's on sale every day. And we also see a consumer that's just looking for their favorite brand at the best possible price. So we get it from both ends, and I think that that's the market that we're catering to.
So do you think you're benefiting from a consumer who is quote unquote trading down, but their version of doing that is shopping at an outlet, same brand, but shopping at the outlet instead?
Yeah, I think so. We don't sell commodity in an outlet center. We're not selling sneakers at the best possible price. We're selling Nikes at value price. So our customer is really looking for brand. That's what they want. And they get those brands that are in our shopping centers. And what's more exciting is that there are new brands that are coming into the business that haven't been in the business before. So last quarter we announced a whole bunch of new tenants that are fresh and new in the outlet space, and we're excited to bring them throughout our portfolio.
To that point of new tenants, one of the things that we've seen among companies, among retail companies right now, is kind of the K-shape. Again, aspirational not doing as well, maybe because they're shopping at your outlets now instead, but the ultra luxury have held up extremely well. Louis Vuitton not as bad as some people thought. Hermes doing very well. Is there any desire to get the ultra luxury into your outlets?
Well, sure. We talked about a shopping center in London. There are markets in the country and obviously overseas that have outlet centers that have great luxury presence in them. And yeah, we're ramping up to add those to our centers as well. We are principally positioned in markets that are those drive-to American tourist locations. And the first thing you want to do is make sure that you're merchandising to the customer that's actually shopping in your shopping centers, because we want to make sure that the shopper has a great shopping experience, but also the retailer has a good experience inside our centers.
How hard is it to get one of those luxury folks? Because so many of them are hyper concerned about brand dilution.
Yeah, first of all, the amount of volume that these brands do in outlets is pretty staggering. So it's probably not as difficult. But, it's really a question of what is the availability of excess inventory, because for the most part, where those particular brands are just selling excess.
Who do you want to get? I need to know this, Stephen.
My number one?
Yeah.
I would say that there's a whole host of Italian brands that I think would do absolutely fantastic in your hometown of Washington, D.C. And, so we're obviously out front working on brands like that.
Okay, well, I'm excited to see that. Now, elsewhere in this world, we've come out, perhaps, of a real estate crisis, of concerns over CRA. It isn't completely gone. The Ares CEO, for example, told me it would take years for it to really figure itself out. If there are continued tensions, issues with real estate, are you ready to jump on opportunities and expand and buy up more real estate?
Well, last quarter was a great example of that. You know, we bought 2 properties, one in Huntsville, Alabama, which was our first non-outlet property. And we bought the outlet center in Asheville, North Carolina, which is our hometown. So, you know, as opportunities present themselves, our balance sheet is in great shape. We just redid our lines of credit. So we really have access to capital. There are significant partnership opportunities out there for us as well. I think people like us as an operating company. So we have best-in-class leasing, marketing, and property operations. There are a number of owners that, you know, outsource a lot of that operational muscle in order to run their properties. We bring that in-house. So we think a little bit more strategically. We think a little bit more long-term. You know, we like to think like general merchandise managers. That's how we run our properties. We run them for the long term.
What about geographical exposure-wise? Is there anywhere that you'd want to be more into that you're looking at specifically?
Well, you know, we like the South. And, you know, the less susceptibility to weather. People at the shop, the outdoor, we're an open-air REIT, and for the most part, when we can find really good property in the South, we can extend that selling season.
Okay, well, let me know when the luxury gets to DC. I'll pay you a visit. Stephen, thank you so much for joining.
It's my pleasure. Thank you so much for having me.
Thank you, Stephen Yalof, the Tanger CEO. Okay, now let's get to some of the price action this morning and get over to Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, Danny. So overall, we are looking at a small gain for the S&P 500, up about 0.4%. Actually, I should say a modest to solid gain for the S&P 500. Most sectors are higher, led by technology, up more than 1%. This is Apple, Microsoft, NVIDIA, and many others are up. And of course, we'll be watching Apple all day ahead of those earnings later today, given the fact that it has been down every month this year. To the downside, materials down about a 1%. Mosaic and a number of the other chemical companies are down. Actually, Mosaic being a fertilizer company, but some of the chemical companies are lower. As for one sector that's outperforming on the week, heading to its best week in 2 months, take a look at biotech. Down just a little bit today, but this week, again, the best week since early March. And a lot of this has to do with Moderna, a good quarter. This index is trading higher in part because of Moderna's quarter. Danny.
Hey, Abby, appreciate it. Abigail Doolittle. Okay, coming up, we're going to get you some of the market-moving events that you need to be watching. That's up next in our Trading Diary. This is Bloomberg.